Welcome back to the Deep Dive, your express route to technical mastery in financial reporting. We're not just skimming the surface today, we're really getting into the weeds of non-current assets. Think of them as the bedrock of the balance sheet.
That's a great way to put it. And if you're gearing up for financial reporting exams, you absolutely know these assets are central. It's where all the complex stuff happens,
Yeah.
revaluations, impairment calculations, capitalization rules. It's all in there.
Right. So our mission today is pretty focused. We want to help you go beyond just, reciting the rules. We want you to think like an examiner to see how these standards connect and where the tricky questions might pop up.
Exactly. We're going to unpack 4 key standards. IAS 16 for property, plant, and equipment, the big one. Then IAS 23 on borrowing costs, IAS 20 covering government grants, and the rather unique IAS 40 for investment property.
And then tie it all together with the big health check IAS 36 impairment, because ultimately all these assets need to be tested to make sure their values hold up.
Precisely. The goal is strategic insight. We want you to see how a decision in one area ripples through the financial statements. Get these wrong, and it impacts your SFP, your P&L, everything.
Okay, sounds like a plan. Where should we start? The foundation.
Let's start right at the beginning. IAS 16, property, plant, and equipment, or PPE. Specifically, how do we determine that initial cost?
Okay, IAS 16 PPE, the absolute fundamental NCA standard. So initial measurement, it's recognized at cost. But cost isn't just the price tag, is it?
Not at all. That's a common mistake. The principle is cost includes all expenditure needed to bring that asset to the location and condition necessary for it to operate in the way management intends.
So beyond the purchase price, what else gets included? Transport, installation.
Definitely. Transport costs, installation, site preparation, any initial testing to make sure it works properly, these are all directly attributable costs. They're necessary to get the future economic benefits from the asset.
Okay, that makes sense. But what about costs incurred around the same time that don't get capitalized? This is often where marks are lost.
Ah, yes, the exclusions. Crucial point.
Yeah.
Any cost that isn't strictly necessary to bring the asset into its working condition must be expensed immediately. It goes straight to profit or loss.
Like what, for example?
Well, think about opening a new factory. You might have advertising costs for the launch, maybe a ceremony. Those are operating expenses, not part of the asset's cost.
Or training staff to use the new machine.
Exactly. Staff training is an operating expense. Costs of introducing a new product made by the machine. Operating expense. And a really important one. Any initial operating losses incurred before the asset reaches its planned level of performance, those also hit P&L immediately.
So the rule is quite strict then. If the asset is physically ready to go, any inefficiencies after that point are operational problems, not capital costs.
Precisely. The asset itself is ready. The subsequent costs relate to running the business, not building the asset.
Now, there's a specific cost that often trips students up, linking IAS 16 with provisions, the decommissioning cost.
Yes, the obligation to dismantle or restore a site later on. If putting the asset in place creates a legal or even a constructive obligation for future cleanup, you have to account for that cost now.
Even if the actual cash payment is, like, decades away.
Even then. But, and this is key, you don't capitalize the full future amount. You have to calculate its present value.
Discounting, back to time value of money.
Exactly. This links directly to IAS 37 provisions. If you estimate a $1 million cleanup cost in 20 years, you need to discount that back to today's value using an appropriate rate. Maybe it's only $200,000 today.
Okay, so you debit PPE for $200K and credit.
Credit a provision liability for $200K, usually non-current. You've recognized the asset cost and the future obligation simultaneously.
But that liability isn't static, is it? Because it was recorded at present value.
Good point. It needs to grow back towards that future $1 million figure over the 20 years. This is called the unwinding of the discount.
And where does that unwinding charge go?
It's recognized as a finance cost in the statement of profit or loss each year. You debit finance cost, PL, and credit the provision liability, increasing it gradually.
So if you miss the discounting or forget the annual unwinding, you've got multiple errors.
Multiple errors. Your initial asset cost is wrong, your liability is wrong, and your annual profit is overstated because you're missing that finance cost. Examiners love testing this multi-step process.
Okay, we've got the initial cost nailed down. Now, how do we measure the asset after that? IAS 16 gives us a choice, right? Cost or revaluation.
That's right, a fundamental choice. The cost model is the default, the benchmark. It's simple. Original cost, less all the depreciation accumulated over time and less any accumulated impairment losses.
Straightforward, verifiable, relies on historical fact.
Exactly. It scores highly on faithful representation in the conceptual framework. It's based on actual transactions.
But then there's a revaluation model. This feels more dynamic, focusing on current value.
It absolutely is. Under this model, the asset is carried at its fair value at the revaluation date, less any subsequent accumulated depreciation and subsequent impairment losses. It embraces the concept of relevance.
What are the ground rules for using this model? Examiners must look closely at this.
They do. Two absolutely critical rules. First, consistency across the entire class of assets.
Meaning?
If you decide to revalue your office buildings, you must revalue all your office buildings. You can't just pick the ones that have gone up in value and leave the others on the cost model. That prevents cherry-picking favorable results.
Makes sense. And the second rule?
Revaluations must be kept up to date. They need to be done with sufficient regularity, the standard's wording, so the carrying amount doesn't materially differ from fair value. This might mean annually for volatile assets, or maybe every 3-5 years for others. Handling revaluation surpluses and deficits.
Right, let's get into the mechanics. What happens when an asset's fair value goes up? Where does that gain go?
A revaluation increase, or gain, is recognized in other comprehensive income, OCI.
Not profit or loss.
Not PL initially. It bypasses the main profit figure and goes into OCI, accumulating in an equity reserve called the revaluation surplus.
Why OCI?
Prudence, mainly. The gain hasn't been realized through a sale yet. Putting in an OCI reflects the increase in wealth, but keeps it separate from trading profits. The double entry is debit PPE, increasing its value, and credit OCI revaluation surplus.
Okay, that's the upside. Now, the tricky part, what if the value goes down? Say an asset was revalued up before, creating a surplus, but now its value is falling.
This is where careful tracking is needed. The decrease is first charged against any existing revaluation surplus for that specific asset.
So you reduce the reserve first.
Back through OCI.
Exactly. You debit OCI revaluation surplus, effectively reversing the previous gain held in equity for that asset, and credit the PPE asset. This keeps the reversal out of PL, matching the treatment of the original gain.
But what if the decrease is bigger than the surplus? Or if there was no prior surplus? What if it falls below its original depreciated cost? That's the critical threshold. Any part of the decrease that either exceeds the existing surplus or occurs when there's no surplus must be charged immediately to profit or loss as an expense.
So there's a potential split, part to OCI, part to PL.
Potentially, yes. You essentially draw down the asset-specific surplus in OCI first. Once that's gone, any further fall hits PL. This reflects a real economic loss relative to the original cost base.
Let's try an example. Original cost $1, depreciated to $700K, revalued up to $1 2 meters, so a $500K surplus in OCI.
Yeah.
Now market crashes, fair value drops to $650K. How's that loss of $550K treated?
Okay, the first $500K of that loss cancels out the surplus, so debit OCI revaluation surplus $500. But the value has fallen to $650K, which is $50K below the $700K depreciated historical cost baseline.
So that $50K hits PL.
Precisely. That remaining $50K loss goes straight to the profit or loss statement.
Yeah.
Debit PL expense $50K. And you'd credit PPE for the total $550K drop. That calculation checking against the depreciated historical cost is vital. Tag the annual depreciation transfer. OCI mechanic.
Now, revaluing an asset upwards usually means a higher carrying amount. Doesn't that mean higher depreciation charge each year too?
It does. And IAS 16 allows for an optional but very common adjustment related to this, the annual depreciation transfer.
Optional? What does it do?
It addresses the fact that the depreciation expense hitting PL is now higher than it would have been under the cost model. This excess depreciation represents, in a way, the piecemeal realization of the revaluation gain through the asset's use.
Okay. So how is it accounted for? It doesn't go through PL again, does it?
No, absolutely not. This is purely an equity movement, shown in the Statement of Changes in Equity, SOCIE. You calculate the difference between the actual higher depreciation charged on the revalued amount and the lower depreciation that would have been charged on the historical cost.
In that difference amount.
You transfer that amount directly from the revaluation surplus reserve to retained earnings.
Yeah.
Debit revaluation surplus, credit retained earnings.
So it gradually moves the unrealized gain from the OCI reserve into retained earnings, making it potentially distributable, but without inflating annual profit figures.
Exactly. It reflects the economic substance. The benefit of the revaluation is being consumed over the asset's life. The Uruguay example in the materials highlights this OCI transfer perfectly. Tag depreciation dynamics.
Let's quickly cover some depreciation specifics. When does it actually start?
Depreciation begins when the asset is ready for its intended use. Critically, this is regardless of when it's actually put into operation.
So if a factory's finished construction on December 1st but doesn't start production until January 1st.
Depreciation starts December 1st. The asset is available for use by management. Its economic life has started ticking down. Delaying use is an operational decision, not an accounting one for depreciation timing.
Okay. And for really complex assets like aircraft, the Paraguay example, we can't just depreciate the whole thing over one lifespan, can we?
No, that would be accurate.
Yeah.
IAS 16 mandates component depreciation for such assets. If an asset has major parts with significantly different useful lives, you have to account for them separately.
Like the engines, the fuselage, the cabin interior.
Precisely. The fuselage might last 20 years. Engines maybe 10,000 flight hours or 10 years. The interior maybe 5 years. You allocate the initial cost across these components and depreciate each one over its own specific useful life.
Gives a much truer picture of expense recognition.
Absolutely. More complex, but much more faithful representation of how the asset's economic benefits are consumed.
One last depreciation point. What if halfway through an asset's life, management realizes it's going to last longer or shorter than first thought? Or the residual value changes, like in the Ecuador example.
That's treated as a change in accounting estimate under IAS 8. And the key rule here is prospective application.
Meaning no going back and fixing past years.
Correct. You don't restate prior periods. You simply take the asset's current carrying amount, its net book value at the date of the estimate change, and spread that remaining amount over the newly estimated remaining useful life.
So it just affects the current and future depreciation charges.
Exactly. It's a forward-looking adjustment. Clean and practical.
Right. We've covered the core of PPE accounting under IAS 16. But big assets often mean big money, big projects, long construction times. This brings financing costs and maybe even government help into the picture.
Absolutely. Two key standards here. IAS 23 for borrowing costs and IAS 20 for government grants. Let's tackle borrowing costs first. IAS 23 answers the question. When you borrow money specifically to build or acquire certain assets, should the interest cost be expensed immediately or added to the cost of the asset itself?
Added to the cost. You mean
No.
capitalized.
Exactly, capitalized.
Yeah.
And the rule is borrowing costs must be capitalized if they relate to a qualifying asset.
Okay, define qualifying asset. What makes an asset qualify?
It's an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Think major construction projects, buildings, power plants, ships, or maybe complex internal software development.
So buying a standard piece of equipment off the shelf, ready to use immediately.
Never qualifies. The borrowing costs associated with that would be expensed as incurred. It's all about that substantial period of preparation.
Got it. So if we do have a qualifying asset, when do we start adding those borrowing costs to its value? Is there a specific start date?
Yes, and it's quite strict. Capitalization begins only when all three of these conditions are met simultaneously. 1. Expenditure on the asset is being incurred. You're actually spending money on it. 2. Borrowing costs are being incurred. You're paying interest on the related loans. And 3. Activities necessary to prepare the asset are in progress. Physical construction or development work is actually happening.
All three have to be happening at the same time.
All three. If you take out the loan in January, but construction doesn't start until March, you expense the interest for January and February. Capitalization only starts in March when all conditions are met.
Okay, clear start criteria. What about the stop criteria? When do we stop capitalizing?
You must stop capitalization when the asset is substantially complete and ready for its intended use or sale.
Even if we decide not to use it straight away.
Even then. Once it's ready, any further finance costs are holding costs, essentially, and should be expensed. They're not part of getting the asset ready anymore.
What if construction gets paused, like a strike, as in the example 5 logic?
Good point. If there's a temporary suspension of active development, you must also suspend capitalization during that period. The interest cost incurred during the suspension hits PL. You only resume capitalization when active work starts again.
Right, so the capitalization period is strictly tied to active progress. Now, the calculation itself, what if we borrowed money specifically for this project?
For specific borrowings, there's a key rule.
Right.
The net borrowing costs rule, or set-off rule.
Meaning?
If you borrow, say, $50 million, specifically for the project, but you only spend $30 million immediately, you might temporarily invest the spare $20 million. Any investment income earned on that temporary investment must be deducted from the gross borrowing costs incurred on that specific loan.
So you only capitalize the net cost.
Exactly. You capitalize the interest paid minus any interest earned from temporarily investing those specific funds. The Ecuador velodrome example illustrates this. You capitalize the true net financing burden of that specific debt during construction.
Okay, that's specific borrowing. What if the company just uses its general pool of funds, its general corporate debt, to finance part of the construction, as in the Venezuela example?
That's more common and a bit more complex. If general borrowings are used, you can't just pick one loan's interest rate. You have to calculate a weighted average capitalization rate.
How's that worked out?
You take all the general borrowings outstanding during the period, calculate their weighted average effective interest rate, and apply that rate to the amount of expenditure on the qualifying asset that was funded by those general funds.
So it's an average rate reflecting the company's overall cost of general debt.
Precisely. It provides a systematic and rational allocation of the general borrowing costs to the asset being constructed.
Okay, switching gears from costs to benefits. Sometimes governments provide financial help for companies acquiring big assets. That's IAS 20, government grants.
Yes. These grants often come with strings-attached conditions the company has to meet.
So when can a company actually recognize the grant? When the cash arrives?
Not necessarily. Recognition is based on assurance. You can only recognize the grant when there's reasonable assurance of two things. First, that the company will comply with any conditions attached to the grant. Second, that the grant will actually be received.
Reasonable assurance, okay. Not absolute certainty, but a high degree of confidence.
Correct. If either compliance or receipt is significantly uncertain, you wait.
Now, assuming we meet the criteria, how do we account for a grant related to buying, say, a depreciable asset like machinery? Do we just book it as income straight away?
No, that's generally not allowed under IFRS for grants related to assets. The required method is the deferred income approach.
Deferred income, meaning we treat it like a liability first.
Exactly. You initially recognize the grant received as deferred income, which is a liability on the statement of financial position.
Why a liability? The government isn't going to ask for it back, hopefully.
It's about matching. The grant is linked to the asset. The asset's cost is recognized as an expense, depreciation, over its useful life. Therefore, the grant income should also be recognized over that same period, effectively offsetting the depreciation expense.
Ah, the matching principle. So the deferred income liability gets released to PL over time.
Precisely. You amortize the deferred income liability to the P&L systematically over the useful life of the related asset. Usually, this is done in line with the depreciation charge.
So, if an asset has a 5-year life, we release 1/5 of the grant income to PL each year, matching the depreciation pattern.
That's the idea. Example 7 shows this clearly. It ensures the net impact on profit reflects the government's contribution over the period the asset provides benefits.
And on the balance sheet, that deferred income liability, does it need splitting?
Yes. Like other liabilities, it needs to be split between the current portion, the amount expected to be released to income within the next 12 months, and the non-current portion, the remainder.
Okay. Now, the unpleasant scenario.
Yeah.
What if the company messes up, fails a condition, and has to repay the grant?
Repayment is treated as a change in accounting estimate. The accounting follows a specific order.
Which is?
First, you reduce any remaining balance of the deferred income liability related to that grant. If the repayment amount is, say, $100K, and you still have $120K deferred income left, you just debit deferred income $100 and credit cash $100K. No PL impact immediately.
But what if the repayment is more than the remaining deferred income? Maybe we only have $50K left deferred, but have to repay the full $100.
In that case, you debit deferred income for the remaining $50K, wiping it out. The excess amount of the repayment, the other $50 in this case, must be recognized immediately as an expense in profit or loss.
So the penalty for non-compliance hits the current year's profit directly if it exceeds what's left deferred?
Exactly. It ensures the financial consequences are reported promptly.
Okay, we've dealt with assets we use in our business PPE under IAS 16, but what about property we hold just to make money from it, either through rent or selling it for a profit later?
Now we step into a different world. IAS 40, investment property. And this distinction is absolutely fundamental because the accounting treatment can diverge quite dramatically from IAS 16.
Why the different standard? A building is a building, isn't it?
Well, the purpose of holding it is different. IAS 40 is for property held to earn rentals or for capital appreciation, or both. Its value is driven more by market factors and rental streams than by its use in production. #, definition and scope.
So define investment property clearly for us. What isn't it?
Okay, it is land or a building held for rental income or capital gains. It is explicitly not property used by the owner in their business for production, supply of goods, services, or admin purposes. That's IAS 16 PPE.
And it's also not property held specifically for resale as part of the company's ordinary business.
Correct. Property held for sale in the ordinary course of business falls under IAS 2 inventories, like a property developer's stock.
What about tricky situations like a building where we rent out most floors but use one floor for our own admin team, a mixed-use property?
Good question. IAS 40 addresses this. If the different portions, the rented part and the owner-occupied parts, could be sold or leased out separately under a finance lease, then you account for them separately. Part IAS 40, part IAS 16.
But often they can't be separated easily.
Right. If they can't be separated, the entire property is treated as investment property only if the owner-occupied portion is insignificant.
Insignificant. What does that usually mean in practice?
There's no hard percentage, but guidance often suggests maybe 10% or less of the usable area or value. If the owner-occupied part is insignificant, you classify the whole thing under IAS 40 for simplicity. If it is significant, the whole property typically falls under IAS 16 PPE. Judgment is required. ## measurement models. The big divergence.
Okay, let's say we have a property that clearly meets the IAS 40 definition. Initial measurement still cost, plus directly attributable costs.
Yes, initial measurement is the same as IAS 16, cost basis.
But subsequent measurement. This is where IAS 40 offers a different path, right?
This is the big divergence. The entity has to choose an accounting policy for all its investment properties. The choice is between 1. The cost model. This works exactly like the IAS 16 cost model, costs less accumulated depreciation and impairment. If you choose this, the investment property is depreciated.
Okay, so that's an option, but the other one?
The other option, and the one that really distinguishes IAS 40, is the fair value model.
How does that work?
Under the fair value model, the investment property is revalued to its fair value at each reporting date. And here are the two killer differences compared to IAS 16 revaluation. First, any gain or loss arising from the change in fair value goes directly to profit or loss for the period.
Straight to PL, not OCI, like with PPE.
Straight to PL. The logic is that changes in market value are the performance of an investment property, so it hits the main income statement.
Wow. And the second difference?
Under the fair value model, the investment property is not depreciated.
No depreciation at all.
None. The argument is that measuring it at fair value each period already captures the change in its economic worth, including any wear and tear or obsolescence reflected in market value.
Yeah.
Adding depreciation would be double counting and would obscure the real performance, which is the fair value change.
So choosing the fair value model means potentially big swings in reported profit based purely on market movements and no depreciation charge smoothing things out.
Exactly. It maximizes relevance, showing the current economic reality, but can lead to more volatile reported earnings. The Deller example 10 shows this PL impact.
And a technical point from that example, fair value under IAS 40 doesn't deduct selling costs, right? Unlike some other standards.
Correct. Fair value here is generally the price in an orderly transaction between market participants. You don't deduct estimated cost to sell, which is different from the fair value less cost to sell concept used in IAS 36 impairment or IFRS 5 assets held for sale. #/ transfers, change of use trigger.
What about moving properties between categories? Say we stop using a factory, IAS 16, and decide to rent it out instead, IAS 40, or vice versa. Examiners must love testing these transfers.
They do. Transfers into or out of the investment property category are only permitted when there's clear evidence of a change of use.
So it has to be a genuine change in how the property is being utilized.
Absolutely. You can't just switch classification to get a preferred accounting treatment. There needs to be a trigger event, like starting development to convert it, or ending owner occupation, or signing an operating lease with a tenant.
Okay, let's walk through the most complex transfer. Moving from owner-occupied PPE, IAS 16, across to investment property, IAS 40, assuming the company uses the fair value model for its investment properties.
Right, this needs a careful two-step approach at the date of the change in use. Step 1. You first apply the IAS 16 rules up to the date of transfer. If the company uses the revaluation model for that class of PPE, you revalue it one last time under IAS 16 rules. Any gain goes to OCI, revaluation surplus. If using the cost model, you just ensure depreciation is up to date.
So you establish its carrying amount under IAS 16 rules first.
Exactly. Step 2. That carrying amount, whether cost or revalued amount, at the date of transfer becomes the deemed cost for the investment property under IAS 40.
And from that point on?
From that moment forward, IAS 40 fair value rules apply. No more depreciation and all subsequent changes in fair value go straight to PL.
What happens to any revaluation surplus that might have been sitting in OCI from its time as PPE? Does that get released to PL now?
No, it stays in the revaluation surplus, OCI. It's only transferred to retained earnings when the property is eventually sold or disposed of, just like any other IAS 16 revaluation surplus. It doesn't get recycled just because the asset changed classification.
Okay. And the other way around. Transferring from investment property, fair value model, back to owner-occupied PPE, IAS 16.
It's simpler. The fair value at the date of the change in use becomes the deemed cost for the asset under IAS 16. From that date on, you start applying IAS 16 rules. Most importantly, you start depreciating it again.
And the past fair value gains that went through PL under IAS 40, they just stay locked into that new deemed cost figure.
Correct. They effectively become part of the historical cost base for future IAS 16 accounting. The Adlington Example 9 demonstrates this transfer process really well.
Right. We've covered how to account for PPE and investment property, including cost, revaluation, depreciation, transfers. But underlying all of this is a crucial safety net: impairment testing under IAS 36, making sure the assets aren't overstated on the balance sheet.
Exactly. IAS 36 is the universal standard for impairment testing across most non-current assets, whether they're measured at cost or revalued amount, though the mechanics differ slightly for revalued assets, as we saw.
So what's the basic principle? When is an asset considered impaired?
An asset is impaired if its carrying value, CV, the amount it's shown at on the balance sheet, is greater than its recoverable amount.
Carrying value exceeds recoverable amount, meaning we couldn't get back what we're carrying it for?
Precisely. It means the balance sheet figure is higher than the economic benefits we expect to recover from either selling the asset or continuing to use it. #tag the impairment trigger.
Do we have to calculate this recoverable amount for every single asset every single year? That sounds like a huge amount of work.
Not necessarily calculate in full detail, no. The first step is an annual assessment for indicators of impairment. You only need to perform the full calculation if there's some sign, some trigger, suggesting the asset might be impaired.
What sort of signs are we looking for? Are there internal and external ones?
Yes. Management needs to be alert to both. External indicators often come from the market or wider environment. Things like a significant, unexpected drop in the asset's market value, adverse changes in the technology, market, economic, or legal environments the company operates in, or maybe a significant increase in market interest rates, which would affect discount rates used in valuations.
Okay, things happening outside the company. What about internal indicators?
Internal indicators relate more to the asset itself or how it's being used, evidence of obsolescence or physical damage. Significant changes in how the asset is used, maybe it's become idle, or there are plans to dispose of it early, or plans to restructure the operation it belongs to.
And perhaps the most obvious one.
Evidence that its economic performance is worse than expected. Persistent operating losses from the asset or the unit it belongs to, or cash flow forecasts that are significantly worse than budgeted.
So if any of these indicators exist, then we have to roll up our sleeves and do the full impairment review.
Correct. The trigger means you now must calculate the recoverable amount and compare it to the carrying value. Goodwill and certain intangibles require annual testing regardless of indicators, but that's a slight complexity. #tag the impairment review calculation.
Right, let's define that crucial term, recoverable amount, RA. How is it calculated?
Recoverable amount is defined as the higher of two specific values. 1. The asset's fair value, less cost to sell, FCLCTS. 2. The asset's value in use, VIU.
The higher of the two. Why higher?
Because the company will rationally choose the course of action that yields the greater economic benefit. If they can get more by selling it now, FCLCTS, than by using it, VIU, they'd theoretically sell. If they can get more by continuing to use it, they'd keep it. The recoverable amount reflects the best outcome available.
Okay. FCLCTS seems relatively straightforward, market price minus selling costs. But value in use, VIU, sounds more complex. It involves future estimates.
It does. VIU is the present value of the estimated future cash flows expected to be generated from the continued use of the asset, plus any residual value at the end of its life.
Present value again, so discounting is key here too. What goes into that calculation?
Several critical components. Cash flow projections. These must be based on reasonable and supportable assumptions covering the asset's remaining useful life. Importantly, they must be pre-tax cash flows and should exclude cash flows related to financing activities like interest payments or income taxes. Just the operational cash in and out, discount rate. This must also be a pre-tax rate that reflects current market assessments of the time value of money and the specific risks associated with that particular asset or cash-generating unit. Getting the right risk-adjusted rate is crucial. Projection period, usually limited to a maximum of 5 years, unless a longer period can be reliably justified, often followed by a terminal value calculation for assets with longer lives.
So VIU is basically a discounted cash flow DCF forecast for the asset. Example 1 really highlights the need for precision in those inputs, cash flows, and discount rate.
Absolutely. Small changes in assumptions can significantly swing the VIU calculation and thus the impairment result. Hashtag tag recording impairment loss. Individual asset.
Okay, so we've compared carrying value, CV, to recoverable amount, RA. If CV is higher, we have an impairment loss, CV minus RA. Where does that loss get recorded?
For an asset measured under the cost model, or the cost model option in IAS 40, the impairment loss is recognized immediately in profit or loss.
Straight hit to the bottom line.
Straight hit. Debit impairment loss, PL, credit accumulated impairment losses, which reduces the asset's carrying amount on the SFP.
What if the asset was previously revalued upwards under IAS 16 and still has a balance in its revaluation surplus in OCI?
The exception. This links back perfectly to our revaluation discussion. If an asset accounted for under the revaluation model IAS 16 becomes impaired, the impairment loss is treated first as a revaluation decrease.
Meaning it goes against the revaluation surplus first.
Exactly. You first reduce any existing revaluation surplus for that specific asset down to zero, recognizing that part of the loss in OCI. Debit revaluation surplus, OCI. Credit accumulated impairment, PPE.
And only if the impairment loss is bigger than the available surplus.
Does the excess amount get recognized as an expense in profit or loss?
So it mirrors the treatment of a regular revaluation decrease. Protect the P&L with the OCI reserve first.
Precisely. The example 2 logic, where a large impairment was mostly absorbed by the OCI surplus before a smaller amount hit PL, shows exactly how this interaction works. It ensures that only the loss bringing the asset below its theoretical depreciated cost impacts current profit. Hashtag impairment of cash-generating units, CGUs.
Now, often an individual asset doesn't generate cash flows on its own. It works as part of a larger group, like a production line or a retail store. How does impairment work then?
You're talking about cash-generating units, CGUs. IAS 36 requires impairment testing at the CGU level if individual asset recoverable amounts can't be determined. A CGU is the smallest identifiable group of assets that generates cash inflows largely independent of other assets.
So you calculate the recoverable amount for the whole CGU and compare it to the total carrying value of all assets within that CGU.
Correct. And if the CGU's total carrying value exceeds its recoverable amount, you have an impairment loss for the CGU that needs to be allocated amongst the assets within it.
How is that loss allocated? Can management just choose where to put it?
Absolutely not. IAS 36 prescribes a strict mandatory allocation sequence. Step 1. First, allocate the loss to write down any specifically impaired asset identified within the CGU, if any. Perhaps one machine is clearly damaged. Step 2. Then allocate the remaining loss to reduce the carrying amount of any goodwill that has been allocated to that CGU. You write the goodwill down, potentially to zero.
Goodwill takes the hit before other tangible assets. Why?
Because goodwill represents future economic benefits from assets that couldn't be individually identified. It's the most sort of intangible and least reliably measured part of the CGU's value. If the CGU is underperforming, the value of that premium paid for future synergies, goodwill, is the first thing considered lost.
Okay, so specific assets first, then goodwill down to zero. What if there's still impairment loss left to allocate after that?
Step 3. Allocate any remaining amount of the loss to the other assets within the CGU on a pro rata basis based on their carrying amounts just before the allocation.
Pro rata, so everything else takes a proportionate hit.
Yes, based on their relative values. However, there's a crucial floor.
Which is?
You cannot allocate the loss to an individual asset within the CGU if doing so would reduce its carrying amount below the highest of its own fair value. Less costs to sell, if determinable, its own value in use, if determinable, and zero.
So an individual asset can't be written down below what it could be recovered for on its own, even as part of a CGU allocation.
Correct. That floor protects individual assets from being excessively impaired just because the whole CGU is struggling. The example 3 logic demonstrates this quite complex but logical allocation process across different asset types within a CGU. So we've covered a lot of ground: IAS 16, 23, 20, 40, and 36. The real skill, especially for exams, is seeing how they all interconnect. A choice made under IAS 16 directly impacts how you might apply IAS 36 later.
Absolutely. And underlying all of this theory is the bedrock of accounting, the journal entries. You can understand the concepts, but if you can't translate them into debits and credits, you'll struggle in application questions.
Couldn't agree more. Every single calculation has a double entry consequence. Depreciation, debit expense PL, credit accumulated depreciation SFP, IAS 16 revaluation gain, debit PPE, SFP, credit OC revaluation surplus, equity, capitalizing borrowing costs, debit PPE, SFP, credit finance costs or cash, avoids the PL expense, impairment loss, debit PL or OCI revaluation surplus, credit accumulated impairment or PPE, SFP reduction. Getting these right is fundamental.
And thinking bigger picture, the financial statement impact is huge. These NCA decisions echo across all the primary statements.
They really do. On the statement of financial position, SFP, obviously the final carrying value is key, but also the classification PPE or investment property, and liabilities like deferred income from grants or provisions for decommissioning. On the statement of profit or loss and OCI, SPL OCI, this is where a lot of the action happens. Depreciation expense, impairment losses hitting PL, usually, finance costs from borrowing or unwinding provisions, and crucially, those revaluation movements, PL for IAS 40 fair value gains losses, but OCI for IAS 16 gains and initial reversals.
Understanding that PL versus OCI distinction for revaluations is probably one of the key differentiators for higher marks.
Without a doubt. It shows you understand the prudence behind OCI for unrealized PPE gains versus the performance focus of PL for investment property value changes.
Which brings us nicely to that underlying conceptual link. Why all this complexity? Why the different models? It comes back to the ISB's conceptual framework, doesn't it?
It absolutely does. It's fundamentally about the constant tension between the two primary qualitative characteristics, faithful representation and relevance.
The cost model emphasizes faithful representation.
Yes. Historical cost is objective, verifiable, based on past transactions. It's reliable. Auditors love it because it's easy to trace.
But maybe not that useful for predicting the future, which is where relevance comes in, championed by the fair value model.
Exactly. Fair value, particularly for investment property, aims to provide the most relevant information for users making economic decisions. What's the property worth now? That's arguably more useful than what it cost 20 years ago.
So the standards try to strike a balance, allowing cost for PPE where operational use is key, but pushing towards fair value for investment property where market value is the key performance indicator.
That seems to be the rationale. For assets used in operations, PPE, reliability perhaps edges out relevance slightly, hence the Koch model allowance. For assets held purely for financial return, investment property, relevance takes precedence, hence the push towards fair value through PL. Grasping that trade-off is moving towards thinking like a standard setter, not just a rule follower. Hashtag outro.
Well, that brings our deep dive into the complex world of non-current assets to a close. We've journeyed through IAS 16 PPE, the specifics of borrowing costs and grants in IAS 23 and 20, the unique measurement rules of IAS 40 investment property, and capped it off with the essential health check of IAS 36 impairment.
It's a lot to take in, but hopefully we've shown how interconnected these areas are. Remember, the real aim for exam success isn't just memorizing rules, but understanding the why. Why does OCI exist for revaluations? Why capitalize borrowing costs? Why the different models for PPE and investment property?
And perhaps a final provocative thought for you to mull over.
If the fair value model for investment property is considered so relevant, providing up-to-date information directly in PL, why does IAS 16 still firmly allow, even default to, the cost model for PPE? A model that can significantly understate the capital actually employed by a business, especially during inflationary times or periods of growth. Why retain that historical cost perspective so strongly for operational assets? Something to think about.
A great point to ponder. This has been another SmartPass deep dive. We'll be back with future episodes exploring more key financial reporting topics to help you prepare effectively.
Don't forget to subscribe to the SmartPass YouTube channel for more expert insights, tutorials, and exam technique guidance. You'll also find links to additional SmartPass study resources, like our comprehensive notes and practice question banks, in the video description below. We're here to support your journey to success.